Hello students, welcome to the lecture on cash flow and funds flow statements. After this lecture, you will be able to learn the following objectives. Understand the cash flow statement, explain various cash and non-cash transactions, explain the preparations of cash flow statements and its analysis, explain the funds flow statement, understand the preparation of funds flow statement, discuss the preparation of schedule of changes in working capital, explain the concept of gross and net working capital, discuss the funds flow statement analysis. Now let us know more about basic concepts of funds flow statements. The basic financial statement, that is the balance sheet and profit and loss account or income statement of business, reveal the net effect of the various transactions on the operational and financial position of the company. These statements do not show as to how have the funds been earned and used during the accounting period. Another statement has to be prepared to show the change in the assets and liabilities from the end of one period of the time to the end of another period of time. Funds flow statement is a modern technique of analyzing financial statement. Fund flow statement shows as to where have the funds come from and where have they been used during the accounting period. It helps in analyzing the movement of funds of a firm between the two balance sheet dates. Meaning of fund: the excess of current assets over liabilities. Meaning of flow: flow means change. When there is a change in the amount of funds, it is said to that there is a flow of funds. The funds flow statement is a statement which shows the movement of funds and is a report of the financial operations of the business undertaking. In simple words, it is a statement of sources and application of funds. Statement of cash flows. Let us see this video to get an idea of the topic Statements of Cash Flow format.
Financial accounting. We're going to talk about the statement of cash flows, which to me is the most practical of all statements because that's how we run our lives. How do you get cash and how do you spend cash? And we will learn there are three basic sources and uses or inflows and outflows of cash. Those come from operating activities, and those operating activities primarily have to do with the income statement. And you'll know that the result of the income statement is net income. So that's always the very first thing on a statement of cash flows. We're going to put down our net income. Then we're going to cruise through the income statement and look for any non-cash revenue and expense items. And so those include things like depreciation expense. Now, since depreciation does not take any cash or spend any cash, we want to add it back. So we're going to add back depreciation to net income. We will also add back any losses because losses did not take any cash out of our pocket when we had those, when we sold our investments or our property, plant, and equipment. Likewise, we will subtract out any gains that we had when we sold investments or property, plant, and equipment because the gain isn't what put the cash into our pocket. It's the cash proceeds from that sale that did it. So we're going to subtract that. In addition, we're going to be analyzing our current assets and our current liabilities. So current assets and liabilities, we're going to look at them for changes. And what we want to look at here is, remember, current assets and current liabilities are our daily activities that go into the daily operations, meaning the income statement. How did you do this period? So the changes in current assets like inventory, accounts receivable. There's ups and downs, means that cash is coming in or going out of our business. Likewise, our liabilities, like current liabilities, like accounts payable, their ups and downs, again, are the ebbs and flows of cash going in and out of our business on a daily basis. So looking at the changes here in current assets and current liabilities and adding or subtracting them accordingly will give us the cash from operations. So we may have a net income on the income statement, but what the real question is how much money did your business generate? So that's what cash flows from operations will tell you. The second section is the investing section, and in the investing section we're going to be analyzing our non-cash assets. Did they go up? Did they go down? And if they went up or down, how much cash did they either bring in or did they spend? So what am I talking about when I say non-cash, non-current? That should be non-current assets. The non-current assets that I'm talking about are your long-term investments. Not the investments that you make because you've got a little extra cash around and you want cash management investments, but long-term investments. Or things like property, plant, and equipment. Did you buy a car this year? Did you sell a car this year? Did you buy a building this year? Did you sell a building this year? So those changes in my non-current assets will either bring in cash or reduce my cash because I made those decisions. The last section has to do with financing. And when we look at financing, we're going to be looking at our changes in our long-term liabilities, such as long-term debt. So if you borrowed long-term debt, does more cash come in? Yes. If you repay long-term debt, does cash go out? Yes. So we're going to look at those changes for the increases or decreases they incur. Also, we're going to look at our changes in our stockholders' equity accounts for any changes that they incur, and we will add or subtract them accordingly. In other words, things like, did we pay a cash dividend this year? Did we sell stock? So those types of things either bring cash into the business or go out. That will give us, when I add and subtract accordingly, our change in cash. And you know what? You'll know that if you got this answer right, even from the beginning of the problem, because the change in cash is nothing more than the difference between your beginning cash balance on that lovely balance sheet and your ending cash balance on your balance sheet. So you know where you're headed. The final thing that you have to disclose is any non-cash changes that flip things from investing to financing or financing to investing. Since no cash came in or went out, but you changed these categories, you have to disclose it. So that's an overview.
A cash flow statement is a document prepared by a company that details how much money is flowing in and out of the business. Specifically, it shows the change in cash and cash equivalents in a given period of time. Along with an income statement, most small businesses prepare a cash flow statement at least every quarter. Some may even prepare one every month. The statement of cash flows contains information about the flows of cash into and out of a company. In particular, it shows the extent of those activities that generate and use cash. This statement comprises part of the financial statements, though its importance has historically been considered less than the income statement and balance sheet. The primary activities listed in the statement of cash flows are: operating activities are an entity's primary revenue producing activities. Examples of operating activities are cash receipts from the sale of goods as well as from royalties and commissions, amounts received or paid to settle lawsuits, fines, payments to employees and suppliers, and cash payments to lenders for interest. Investing activities involve the acquisition and disposal of long-term assets. Examples of investing activities are cash receipts from the sale of property, the sale of debt or equity instruments of other entities, and repayment of loans made to other entities. Financing activities are those activities resulting in alterations to the amount of contributed equity and the entity's borrowings. Examples of financing activities include cash receipts from the sale of the entity's own equity instruments or from issuing debt, proceeds received from derivative instruments, as well as cash payments to buy back shares, pay dividends, and to pay off outstanding debt. The statement of cash flows also incorporates the concept of cash and cash equivalents. You can use the direct method or the indirect method to present the statement of cash flows. The direct method presents the specific cash flows associated with items that affect cash flow. Cash collected from customers, interest and dividends received, cash paid to employees, cash paid to suppliers, interest paid, income taxes paid, various cash and non-cash transactions. A cash flow statement and non-cash transaction encompasses any aspect that undergoes depreciation or amortization. These includes transactions such as the conversion of bonds to other types of assets or vice versa, lease agreements that lead to a purchase such as commercial real estate rentals, and the exchange of any asset for another asset that is not cash. Items such as interest rate payments are not non-cash transactions. Although non-cash transactions do not normally appear on a cash flow statement, an accountant can adjust a cash flow statement to factor in such transactions. The indirect method of cash flow statement preparation. The indirect method computes the end of year cash flow by adding up net income and rule items. The accountant obtains net income from the company's income statement. Rule items include all non-cash transactions. Let us see another video which would explain the topic briefly.
Point is prepared by Julie Lamb and voiced by Stephen York. How to create a cash flow statement. What is so important about a statement of cash flow? Cash is king in business. It organizes the flow of cash, and it's an important tool for key decision makers. A statement of cash flow will allow companies to see the inflow and outflow of cash. Most companies use the indirect method to consolidate their statement of cash flows. The statement is divided into operating, investing, and financing activities. This is a basic form of a statement of cash flow. First, the operating activities recognize the adjustments made to current assets and current liabilities. It includes the daily cash or cash equivalent transactions during normal operations. Investing activities are transactions that include purchasing and selling of long-term assets. Financing activities are cash received from debt and equity financing. Some examples are sale of stock, cash dividends, and retirement of notes payable. In order to prepare a statement of cash flow, you need to have a prepared balance sheet and income statement. During our demonstration, we will be using financials from ABC Company. Beginning with our income statement, we need to identify our net income. Going to the statement of cash flow, we have now recognized net income. Adjustments to net income need to be made from operating activities. These activities can be found from current assets and current liabilities on the balance sheet. First, non-cash current asset is accounts receivable. Looking at our diagram on the bottom, we see that current assets, when we have a decrease, we need to add this change to net income. Looking at 2008, moving into our current year of 2009, there has been a decrease of $5,700. The decrease in accounts receivable has been recognized. We'll apply the same method for the remaining current assets. Next, we will move to current liabilities. Under current liabilities, when you have a decrease, you will need to subtract this change from net income. Looking at accounts payable for 2008, moving into current year of 2009, there has been a decrease of $4,950. This decrease in accounts payable has been recognized. We'll apply the same method for the remaining current liabilities. Going back to our income statement, we will need to identify our depreciation expense, loss on sale of equipment, and the loss and retirement of bonds. This will then flow into operating activities. The net cash provided by operating activities has been noted. Investing. During this period, ABC sold equipment. This will be recognized under investing activities. Net cash used in investing activities has been noted. Financing. In this period, ABC retired bonds payable and paid dividends. Both will be recognized under financing. Net cash used in financing activities has been noted. The net increase is found by adding net cash provided by operating, investing, and financing activities. Next, we will add the cash balance at the prior year end to find cash balance for the current year. Notice the balance for the prior and current year match the balance sheet. Now we have completed a statement of cash flow.
How to create a statement of cash flows. Preparations of cash flow statement and its analysis. Cash flow analysis is a method of analyzing the financing, investing, and operating activities of a company. The primary goal of cash flow analysis is to identify in a timely manner cash flow problems as well as cash flow opportunities. The cash flow statement. Cash flow statements facilitate decision making by providing a basis for judgments concerning the profitability, financial condition, and financial management of a company. While historical cash flow statements facilitate the systematic evaluation of past cash flows, projected cash flow statements provide insights regarding future cash flows. Projected cash flow statements are typically developed using historical cash flow data modified for anticipated changes in price, volume, interest, rates, and so on. To enhance evaluation, a properly prepared cash flow statement distinguishes between recurring and non-recurring cash flows. For example, collection of cash from customers is a recurring activity in the normal course of operations, whereas collections of cash proceeds from secured bank loans is typically not considered a recurring activity. Cash budget. In contrast to cash flow statements, cash budgets provide much more timely information regarding cash inflows and outflows. For example, whereas cash flow statements are often prepared on a monthly, quarterly, or annual basis, cash budgets are often prepared on a daily, weekly, or monthly basis. While cash budgets are primarily concerned with operational issues, there may be strategic issues that need to be considered before preparing the cash budget. For example, predetermined cash amounts may be earmarked for the acquisition of certain investments or capital assets or for the liquidation of certain indebtedness. Free cash flow is defined as net cash flow from operations less the following three items. Cash used by essential investing activities, example, replacement of critical capital assets, scheduled repayments of debt, normal dividend payments. Ratio analysis. In addition to cash flow statements and cash budgets, Ratio analysis can also be employed as an effective cash flow analysis technique. Ratios often provide insights regarding the relationship of two numbers. Example, net cash provided from operations versus capital expenditures that would not be readily apparent from the mere inspection of the individual numerator or denominator. While ratio analysis may be used in conjunction with the cash flow statement and/or the cash budget, ratio analysis is often used as a standalone attention directing or monitoring technique. Additional benefits. Dick Levin suggests the following benefits that stem from cash forecasting, that is, preparing a projected cash flow statement or cash budget. Knowing what the cash position of the company is and what it is likely to be avoids embarrassment. A firm that understands its cash position can borrow exactly what it needs and no more, thereby minimizing interest, or, if applicable, the firm can invest its idle cash. Walking into the bank with a cash flow analysis impresses loan officers. Cash flow analysis deters surprises by enabling proactive cash flow strategies. Cash flow analysis ensures that a company does not have to bounce a check before it realizes it needs to borrow money to cover expenses. In contrast, if the cash flow analysis indicates that a loan will be needed several months from now, the firm can turn down the first two offers of terms and have time for further negotiations. Funds flow statement. The funds flow statement is the earlier version of the statement of cash flows that is now required to report changes in an entity's cash flows during an accounting period. The funds flow statement was required under GAAP from the period 1971 through 1987. The funds flow statement primarily reported changes in an entity's net working capital position between the beginning and end of an accounting period. Cash flow statement, direct method. The direct method of presenting the statement of cash flows presents the specific cash flows associated with items that affect cash flow. Items typically affecting cash flow include cash collected from customers, interest and dividends received, cash paid to employees, cash paid to suppliers, interest paid, income taxes paid. The advantages of the direct method over the indirect method is that it reveals operating cash receipts and payments. Cash flow statement, indirect method. Under the indirect method of presenting the statement of cash flows, the presentation begins with net income or loss, with subsequent additions to or deductions from that amount for non-cash revenue and expense items, resulting in net cash provided by operating activities. How to prepare a cash flow statement? The most commonly used format for the statement of cash flows is called the indirect method. The general layout of an indirect method statement of cash flows is shown along with an explanation of the source of the information in the statement. A less commonly used format for the statement of cash flows is the direct method. The general layout of the direct method statement of cash flows is shown along with an explanation of the source of the information in the statement. Concept of gross and net working capital. Working capital of a company is one of the most important measures in any financial statement that is also easy to calculate. It is a reflection of the current financial condition of a company. Working capital refers to its financial health and is calculated by subtracting its current liabilities from its current assets. Gross working capital. Gross working capital refers to the amount which the company has invested into the current assets. Current asset includes cash, stock, debtors, or anything which can be converted into cash within a year. Net working capital. Net working capital refers to the difference between the current assets and current liabilities of the company. Current asset, as explained above, will be same, and current liabilities include trade creditors, bills payable, outstanding expenses, or any debt which company has to pay within a year. Preparations of funds flow statement. Fund flow statement is prepared and interpreted on the basis of net working capital concept. Funds flow statement measures and presents in an analytical manner the summarized version of the numerous flows of funds for a specific period. Fund transactions. There is a plenty of business transactions which result in flow of funds or which cause changes in working capital. For this purpose, all the business transactions are classified into A. Those transactions which increase funds, that is, sources of funds. B. Those transactions which decrease funds, that is, application of funds. The following transactions do not affect the flow of funds. These are transactions between two current assets, transaction between two current liabilities, transactions between current assets and current liabilities, transactions between two non-current or fixed assets, transaction between two long-term liabilities, transactions between non-current assets and long-term liabilities. As against this concept, any transaction between a current account and a non-current account affect funds. These are transaction between a long-term liability and a current asset, transaction between a long-term liability and a current liability, transaction between a non-current asset and a current asset, transaction between a non-current asset and a current liability. Importance of funds flow statement. The following are the benefits of funds flow statement. It provides a detailed analysis and understanding of changes between two balance sheet dates. It shows the fund mobilization and canalization. It helps to take fund projections for the future. It is a useful technique to measure the quantum funds needed for efficient operation of a firm. Preparation of funds flow statement and its analysis. The preparation of fund flow statement has the following steps. Schedule of changes in working capital. It can be prepared by comparing the current assets and current liability of two periods. Rules for preparing the schedule. An increase in current assets results in increase in working capital. Decrease in current assets result in decrease in working capital. Increase in a current liability results in decrease of working capital. Decrease in a current liabilities results in increase in working capital. Advantages and disadvantages of cash flow statement. The cash flow statement has several advantages, which are: work as management tool to assess the liquidity of an organization, helps employees to assess the overall viability of their employer, help investors to evaluate the future growth potential of an organization, help stockholders to know if the organization is generating enough cash to pay dividends, helps creditors to know if their customers would be able to pay credit, help financial institutions in equating the borrowing capacity of an organization. Disadvantages are: consumes a lot of time, as the preparation of cash flow statement requires a thorough and complete understanding of different activities of the organization. Requires proper skills to understand and analyze the information revealed. Lack authenticity if the incorrect data is used to prepare cash flow statements. Provides scope for the manipulation of financial data to misguide the investor and government. Now, in the end, let us summarize what we have learnt in this lecture. Summary. Fund flow statement shows as to where have the funds come from and where have they been used during the accounting period. The funds flow statement is a statement which shows the movement of funds and is a report of the financial operations of the business undertaking. The funds flow statement primarily reported changes in an entity's net working capital position between the beginning and end of an accounting period. The statement of cash flows is quite useful for revealing the existence of cash flows that are not readily apparent from the results listed in the income statement. Working capital of a company is one of the most important measures in any financial statement that is also easy to calculate. A cash flow statement is a document prepared by a company that details how much money is flowing in and out of the business. Cash flow statements facilitate decision making by providing a basis for judgments concerning the profitability, financial condition, and financial management of a company.